Hello, my name is Jay White. I'm an EA, and the name of my business is the JPW Group. We've chosen a very light subject today, and so we're going to be talking about a partner's basis in a partnership. And so what I'm going to be doing is you'll be able to take an opportunity to see each of the different 21 slides, but I want to just spend about 15 minutes to give you a quick overview of how the presentation and the course is designed and what the goal is to accomplish and what our accomplishments are going to be once the course has been delivered. So in the first few slides, I want to try to get back to basics in the discussion of this. One of the things that I find in sitting through different class events and listening to topics such as this is there doesn't seem to be any discussion given to the very, very front part of basis calculation. In other words, a partner is going to contribute something, regardless, whether it's property, whether it's services, with something that in return receives an interest in the partnership. But what is contributed has a basis to it, and that's going to lead us to our calculations for our basis in the partnership interest. So we need to know exactly what it is that has a value to us, what that value is, as we put in anything of value to the business, to the partnership, to get our fair share. So the first few slides are going to be slides that discuss just that. Obviously, pretty well know what it is when we make a purchase of an item. We know what our basis is in that item. It's the cost, and maybe adjustments to that's either going to increase or decrease what our ultimate cost is in that basis. We come up with an adjusted basis. So we want to discuss those kind of things. The other part of this is we're going to be discussing ongoing adjustments to basis. So in the first few slides, we'll be covering here, as you can see, purchase of an asset, and then that asset is put into the business. In the presentation, we would be discussing assets that are put into the business or contributed to the business for our share of the partnership, and what the value of a gift would be that we're putting in. So what's the value of our gift or the gift received by us? And then what if we put in something that was inherited by us? So maybe we have property that was inherited and we use that property to put it in. What's our value? What's our basis in the property? So some of those things are commonly overlooked, and I want to go into some presentation of the valuation of the property we're using to contribute and to receive partnership interest as a result of that contribution. So clearly, if it's cash, we know if we put $100,000 of cash in, we know what our basis is in that. But if we put $100,000, or we're thinking it's $100,000 of other property, is that truly the case? So we'll be discussing some of that. So the presentation is broken down into 5 sections. And the first is what I just taught to you about. How do we come up with the valuation of what we're actually contributing to the partnership in return for our share of the partnership? And we want to make sure that we have the proper valuation. Anytime that we don't have the foundation of the basis from the ground, nothing is going to tie back in to get us a proper basis. So this is something that gets overlooked a lot of times, and I want to spend some time on that. That represents slides 2 through 5. And then we're going to be talking about events that happen during the year that affect our basis. Or actually, we're going to be talking about what the basis of our interest in the partnership will now be as a result of our acquiring interest. So if we acquire interest by contributing cash plus property, we want to know what that gets us as far as a basis goes in the property, or in the determination of the partnership interest that we've received. So you can see that we may have acquired it by contributing at the very beginning of this thing. It may be that we acquired it because we contributed services. So we will talk about that contribution of our own personal services in return for an interest in the partnership, an ownership interest in the partnership. Could be that we purchase from another partner, not a contribution to the partnership itself, but we actually purchase another partner's interest from them. So how is that determined? What is our basis as a result of that activity? In gift, it doesn't mean that we're gifting something to the party. The property that we're putting in there is not gifted to us. This is if we receive a gift of partnership interest, what's our basis in that? And then if someone who's a partner passes away and then deems us the beneficiary, we inherit the value of their partnership. What is that? So we want to talk about that. During the year, there's going to be changes in the valuation of the partnership. So that's going to happen annually, and it's going to happen during the year. Generally, at our point, we get this one time a year unless we're doing on-site or ongoing bookkeeping and accounting work for them. Otherwise, we only see it at tax time. So we'll have one time to make all these entries that affected basis, whether it's an increase in our basis or whether it's a decrease in our basis. And those are covered in slides 11 through 12. Our determination of basis at the very beginning, which I just went into, that's covered in slides 6 through 10. And then the annual adjustments are covered 11 through 12. We all know that liabilities become a big part of our discussion as to what our basis is, and liabilities adjust those bases. In some cases, there are general rules that always impact us no matter what. There are no exceptions, and these are what they are. So I did want to just throw a slide in there on the general rules that we always have to think about, and will have a tax impact on us. And so I want to throw that in there. And, as you can see on this slide, the assumption of a partner's individual debt or a partner's share of partnership debt, the way that's viewed is that seems to be a very confusing issue for a lot of people. But in reality, anytime debt is received or debt is paid down, it is something that is treated as a cash event. So if I take on debt on behalf of the partnership, then my share increases in the partnership because it's treated as if I contributed money for that debt, because the partnership no longer has that debt. In the same token, though, if I have a share of the partnership's debt and my basis is includes that event, if some of the other partners pay down or buy out my particular share of that debt, that's as if I've received cash, a distribution from the partnership. And so my basis goes down as a result of that. So there's some of these things I just wanted to point out as far as how they're treated. So back to the liabilities. So one of the things that I want to talk about as far as liabilities is, what type of liability actually does apply. Not all liabilities will. And so the first thing is defining liability. What constitutes a proper liability for the part of the partnership that one can assume and take on, and that is a qualifying liability. Then, another one that we'll be talking about, of course, is we all hear the recourse, non-recourse, and qualified non-recourse. And I go into details. All of this is covered on the liability side on slides 14 through 18. You'll be able to take a look at these at your leisure, of course. Then I wrap it up in the fifth section, which is describing the two different types of basis. One of the things that's not very many times presented in classes is the outside basis and the inside basis. And so because there's not much discussion on those two issues, two types of basis, that's one of the things that does tend to lend itself to more confusion. So with outside basis, we're really looking at what the basis of fact to each partner is in their partnership interest. And on the inside basis, it's what the partnership's tax basis is in each asset. So I go through here and I actually do and present what the two types of bases are and the examples of an inside and an outside basis, and what the tax consequences are of actions on the inside and outside basis. So what happens if we're looking at inside basis, because that's from the partnership's perspective, and what will trigger a tax consequence, or what the tax consequence will be as a result of actions by the partnership itself. And then the outside basis is the tax consequences of actions by the partners themselves, not necessarily the partnership. So that's where we conclude and we wrap it up. So that's a brief overview of how the slides are laid out and what the presentation and the class and the course is going to be teaching, the different 5 sections and the objective of the entire course itself. There are 21 slides, and so at this point there may be some tweaking to try to make them look a little more inviting and things, but the content is what you see pretty much. And with 21 slides, that is going to divide out to about 4.75 minutes per slide. So there's a lot to cover here, and I definitely want to make sure that we get the material covered, and we cover it in a way that people can walk out with usable information. Thanks an awful lot for listening to the overview of this, and I hope to see you soon.
Well, very good. Thanks, Jay, for that. And if you'll go ahead and mute, then I'll go ahead and bring up the presentation and go into the overview of my part.
Okay.
Welcome to our webinar on IRS notices and penalty abatement. You'll find that this webinar is broken down into 6 segments, each recorded separately, so you can go back and review each section at your will and at your leisure. So let's go ahead and get started. First of all, let me introduce myself. My name is Gary LaRoy. I've got a Master of Arts in Communication and MBA, but most importantly, I'm an enrolled agent. I've spent over 16 years as an educator teaching people at the undergraduate and the graduate level, primarily in the area of business. For the past 7 years, I've been focusing on tax resolution as well as tax preparation, and have experience in handling routine case resolution as well as more exciting types of resolution work, such as offers in compromise. Today, we're going to be focusing on those notices that we get from the IRS and how to deal with them, and really looking deeper into some of the issues that may arise once we've identified this one issue. All too often, I think we rush into solving the immediate problem without looking deeper into the client's history to see if there's any way that we can gain some relief for them, or if there are other outstanding issues that need to be addressed. If you want to get more information about us, you can go to our website, taxproez.com, or please feel free to give me a call or send me an email. I would love to talk with you. So section 1, we're going to be looking at practice rights before the IRS. This is a topic that is gaining a lot of interest, and before we start getting into dealing with notices and dealing with tax resolution issues, such as issues that arise in collections, it's important to understand who can represent whom before the IRS. Practice rights for enrolled agents include the enrolled practitioners, enrolled agents, certified public accountants, and attorneys. And we'll look at the unlimited rights that these three categories of individuals have under the category, the broad category of enrolled practitioner. We'll also look at the unenrolled practitioners. This is a new category that came about as a result of the Loving versus IRS case that abolished the old RTRP, the Retired Tax Preparer Program, that occurred several years ago and then was overturned by a circuit court decision. And then we'll look at other people that have the right to gain information but have no representation rights before the IRS. Enrolled practitioners have unlimited practice before the IRS. That means that enrolled agents, attorneys, and CPAs have the ability to represent a client through the representation process at the beginning levels, but all the way through appeals, collection due process, equivalency hearings, the full breadth of representation before the IRS. Now you notice that there is an asterisk because enrolled agents have a federal license which allows them to practice in any jurisdiction of the United States and really outside of the United States, wherever the IRS has a presence. Attorneys and CPAs are limited to those states where they are admitted to the bar, are members of the accountancy practice in that particular state, where they're licensed in that state. But we also have representation rights for all taxpayers. As we'll see with the unenrolled practitioners, they are limited to practitioner rights for people that they prepare taxes for. However, an enrolled practitioner can represent anyone that is filed in any way, whether they filed themselves or whether they paid another tax practitioner to file for them. Unenrolled practitioners, which is a single category for the AFSP, that's the annual filing season program certificate of completion holders, have limited practice rights before the IRS. Their practice rights are limited to returns that they have personally prepared. Another category or another qualification there demands that they not only have prepared that return, but they must have been an AFSP certificate holder in the year they prepared it and in the year where they're seeking to represent the individual. They still have the ability to file a 2848 power of attorney form, but they can only take the first step in the representation process. They can go to the preferred practitioners service line, the priority service line that is available for the practitioners, PPS we refer to it. They can file paper notices or paper responses that they've received from the unenrolled practitioners are those that have the AFSP certificate of completion. That's the annual filing season program. They are limited in their practice before the IRS to the first level of appeal, not really appeal. Unenrolled practitioners are a special category of practitioners that hold the annual filing season program certificate of completion. They have limited practice rights before the IRS. They can only represent a client at the very first level within the IRS. They cannot do an appeal and they cannot go beyond that. Their practice is limited to returns that they have prepared. And there's also a provision that states that they must have been an annual filing season program certificate of completion holder. That's a mouthful. Both when they prepare the return and when they seek to represent the person before the IRS. So their limitations are very, very strict in that area. But then there are others, and others have no practice authority in terms of representation. But they can get informational requests from the IRS. They can fill out a form 8821, have the client sign it, and they can receive information from the IRS. However, they do not have the ability to represent the client, to make a phone call on behalf of the client, or to make a representation to the IRS on behalf of the client. They can advise the client, tell the client what the client needs to do, but they have zero representation rights before the IRS, but they have unlimited rights in terms of gaining information about the client from the IRS with the client's approval. Well, let's take this a step further and let's look at the different forms that we use for representation. Looking at the different representation levels between enrolled agents and the AFSP holders and the others, the enrolled agents or the enrolled practitioners and the unenrolled practitioners can both use Form 2848, which is the power of attorney. The power of attorney gives you the right to contact the individual on behalf of to contact the IRS on behalf of the individual. The Form 8821 is just a tax information authorization. Any of these categories of practitioners can use that form, and again, that's simply a request for information. Now, there's some debate within the practitioner community about which form you use at which time. I prefer to use the 8821 if I'm just providing information to the tax holder and trying to clarify what their position is, because I don't want to communicate in any way, shape, or form at that level of representation that I am actually going to be contacting the IRS on their behalf. So I separate my practice out a little bit differently than some others do. I have a good friend that spent 30 years with the IRS, has spent 7 years in practice now as an enrolled agent, and he always gets a Form 2848 because he doesn't want to go back and get a second form signed if he escalates the representation that he's doing. So which form do you use? Again, it's a matter of preference, but you must use the Form 2848 to gain authorization to act on behalf of the client. Using a 2848 and actually contacting the IRS on behalf of the client can trigger IRS activity. You may be calling in on a single issue, but the agent may see some other issues in there that trigger them to take additional action. I prefer to wait 8 to 10 days, which is about what it takes to get the authorization, the 2848 or the 8821, into the IRS, and to get all of my data down electronically. Now, that doesn't set off any flags at all within the IRS and doesn't set up any trigger activities on their behalf. So that concludes our session 1. It's kind of a brief section, but I think it's important for us to be able to go in and to understand the differences in representation rights, what we can do and what we can't do with our clients and on behalf of our clients.